This is The Gist, the essential podcast for the discerning listener.
Welcome to The Gist. I'm John.
And I'm Mary. It is Tuesday, July 21st, 2026. Let's get you up to speed.
Let's start with the gist view. The European Union just dropped a massive hammer on Google. By January 2027, the tech giant has to share its anonymized search data with artificial intelligence rivals.
And by July 2027, Google has to open 11 core Android features to third-party artificial intelligence assistants. The European Union is using the Digital Markets Act, their big tech competition law, to force this change.
Let's look at who benefits here and why. Google has two massive advantages. They are the default search engine on 2 billion devices, and they have 20 years of search data. That data trains the best artificial intelligence models.
Naturally, Google guards those logs fiercely. But Brussels is prying the vault open. They want to give domestic European startups a baseline to compete. If you don't have 1 trillion searches to learn from, you simply cannot catch up.
It all comes down to resource flows. American tech companies buy their market share with sheer capital. Look at Oracle. They are cutting 30,000 jobs right now. Why? Just to finance their share of Stargate, a massive $500 billion artificial intelligence infrastructure build.
Europe does not have that kind of tech capital laying around, so the European Union offers a regulatory subsidy instead. They use a law to guarantee distribution for local projects, like the new €1 billion artificial intelligence lab backed by the software firm SAP.
It is a classic playbook. Think of the 1996 US Telecommunications Act. That law forced monopoly phone companies to lease their copper wires to scrappy new upstarts. The European Union is doing the exact same thing today, just with Android code and search data.
Moving to the global overview, next week, Open Artificial Intelligence CEO Sam Altman is heading to Washington to brief the Trump administration on artificial intelligence models.
On paper, this is about collaborating on federal safety frameworks. But watch the incentives. When industry giants help write the rules, they naturally set the safety bar incredibly high.
Exactly. That creates massive compliance costs. It essentially builds a giant regulatory wall. Who gets kept out? Smaller developers who cannot afford to jump through those legal hoops.
Meanwhile, Wall Street is rethinking legacy software. Financial analysts are downgrading giants like Adobe and Salesforce. Investors are pulling their capital out of traditional subscription software.
They are pricing in a hard reality. Generative artificial intelligence is not just going to enhance these core business tools, it is going to replace them. The money is flowing out of old software models and directly into artificial intelligence capability.
And speaking of where money flows, we have some fascinating economic data from Marginal Revolution on ideological capital frictions. That is a fancy way of saying political polarization costs real money.
It really does. The data shows Democratic-leaning business professionals will walk away from $210,000 in annual partnership income just to avoid working with someone from the other party. Republicans do the same thing, walking away from about $100,000.
It is a massive structural inefficiency. People are putting their social alignment above their own profits.
Let's pivot to the European perspective. Energy markets are flashing red again. Violence near the Strait of Hormuz, a crucial shipping corridor in the Middle East, has pushed European natural gas prices to a 4-month high.
Traders are now baking permanent instability into their prices. This hits Europe's industrial base hard. It also stalls broader economic growth. When governments have to spend more on expensive fossil fuels, they lose the leverage they need to pay down their national sovereign debt.
In another sector, European Union rules are actively blocking Europe's own ambitions. The bloc wants to build massive aerospace companies to compete with the United States.
but they are colliding with their own antitrust rules. Lorenzo Mariani, an executive at the Italian aerospace giant Leonardo, points out the contradiction. Regulators want these companies to merge, but then demand huge structural concessions to approve the deals.
It creates an institutional bottleneck. You need massive concentrations of capital to challenge United States aerospace dominance. Right now, European Union regulations prevent that money from pooling together.
Down on the ground, European Union agricultural subsidies are actually making healthy food more expensive. Between 2021 and 2025, the cost of a healthy diet in the European Union jumped 36%.
The incentives are skewed. Farm subsidies primarily flow to meat and grain producers. That artificially inflates the price of vegetables. The big commodity operators consolidate the capital, and the costs get passed directly to the consumer.
Over in healthcare, we are seeing a brilliant shift away from physical resource dependencies. In Turin, Italy, the diagnostic centre J Medical just installed Philips' 200th low-helium MRI machine.
Standard MRIs require a lot of helium, which is prone to supply shocks. This new machine uses artificial intelligence to run efficiently on a tiny fraction of that gas. Private operators get to lower their daily overhead and bypass a volatile global supply chain entirely.
Finally, institutional money is quietly scooping up Italy's famous but fragmented food producers. Animo's private investments just bought a majority stake in Terre di Puglia. They are building a unified snack manufacturing hub.
It is a textbook private equity play. They buy up independent local producers, roll them into one unified operation, and extract the profit margins that used to be spread out across the countryside.
So, what's the temperature today? Across the board, we are watching regulators and investors try to force the future into a shape they can control. Whether it is Brussels prying open Google's data vault, Wall Street ditching legacy software, or private equity rolling up Italian snack makers, the game is exactly the same. Consolidating leverage. Old moats are drying up fast. Those who can secure fresh data, alternative energy routes, or war infrastructure are moving aggressively to capture the high ground.
Well said. If you found today's breakdown useful and want to keep this kind of daily analysis in your back pocket, you should subscribe to The Gist. It is completely free, and you can join us by tapping the link right there in the show notes.
We'll see you next time. Stay sharp.
The Gist, News Digest, and podcast are entirely written and produced by artificial intelligence. The Gist is out 3 times a day, every day, providing you with a liberal perspective on what to expect next. For more information and donations, visit thegist.online. Thank you for listening.